Hello traders, welcome to Sammybrainfx. If you're new to our channel, please do well to like and subscribe. So like our videos so you continue to receive updates from us. Alright, let's dive in. The topic before us today is don't hit that buy or sell button without these confluences. Don't hit that buy or sell button without these confluences. So as a trader, the only way you can be successful is that you have a rule-based system. You must have a rule-based system for you to be able to succeed as a trader. If you just traded anything before you, any pattern you see, you just jump in and just take trades anyhow, be inconsistent, and you will never make it as a trader. You will never make it as a. So without these systems, without these things being put in place, without these rules, you will never make it as a trader. This is very, very important. So what is a rule-based system? It's just like telling yourself, oh, these are the things that I must see the market doing before I place my trade. If these things are not in place, I'm not going to click that buy button, I'm not going to click that sell button. So you stick to the rule. You should be consistent with this. You are consistent, you're doing the same thing. You are not chasing trade, you are not chasing the market, you are waiting for it to come to you. Now, another thing to note is that you don't have to be right all the time. Okay, it's not about what I analyzed or what I predicted came to pass. No, it's for you. Your success lies when you are consistent with what you are doing and you keep doing it over time. I would advise you try this in, say, 20 trades. Alright, when you try this out in 20 trades, you analyze this, about 20 times. You practice it, you see the outcome. That's how you build consistency. So just practice this, stick to the rule. No matter what the market is doing, no matter what it's showing you, make sure you have a rule-based system. Okay, so there are things you should see the market doing before you hit that buy or sell button. Alright, so let's dive in. Number one thing we're going to be looking at is the market trend. So you should ask yourself, what is the trend of the market? Is the market bullish? Is the market bearish? Okay, you must know the trend of the markets. For example, if the market is a bullish market, you should be seeing something like this. You'll be seeing price making a series of lower high, lower low, lower high. Higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low. Now this is a bullish market. Okay, meaning in this kind of situation you are looking out for a buy. Alright, so now if it's a bearish market, what will you be looking out for? You'll be looking out for price doing a series of lower high, lower low, lower high, lower low, lower high, lower low, lower high, lower low. You know that the market is in a downtrend. Okay, so in this case you are looking out for a sell. Alright, so now this is an example of a bullish market. Okay, so if it's a bullish market, where are we looking at for to buy? We're looking at for a demand zone to buy. But if it's a bearish market, for example, we are looking at for a supply zone to sell from. This is in a bearish situation, but this is a bullish situation. So if it's a bullish market, you are looking at for a demand zone. But if it's a bearish market, you are looking at for a supply zone. Alright, so number one, the market trend. Number two, either a supply or a demand zone. Okay, then number three, fair value gap. Okay, after you have known the trend of the markets, you have seen where your demand zone is, where you have your order block. The next thing to look out for is your fair value gap. There must be a fair value gap. Okay, there should be a fair value gap. And the next thing you look out for is a break of structure or a change of character, as the case may be. Now, a break of structure is, okay, for example, if it's you have a bearish move, for example, a bearish move, let's say you're having this. Okay, price is going down. You have a break of structure. Another break of structure. Now, so if I'm looking at selling here, if this is my supply zone, I must make sure that there was a break of structure to the downside. Okay. So I'll first of all see my trend that it's a downtrend, and the next thing I'm looking out for is a break of structure. So there's a break of structure to the downside. Okay, so I'm waiting for price to tap into the zone before I look at for a sale. So there must be a break of structure. Okay, the trend of the market first, your supply zone or a demand zone. This is for supply zone, and then the next thing is your fair value gap. There should be a fair value gap. We are going to see that in the real chart. All right, so the next thing I said, break of structure. Okay, break of structure. This is a break of structure. We've seen it here. And for the bullish example, we have it here, break of structure here. Now let's put this here. Let's have this here. This one is for supply zone. For supply zone. Supply zone. This one is for demand zone. So the next thing you look out for is order block mitigation. Now this is my order block, which of course is the same thing as my demand zone. I must wait for a mitigation at that order block or at that demand zone. Okay, this is for buy. If this is a sell, I must wait for mitigation at that supply zone. Okay. Okay, very, very important. We should know that there should be mitigation. Now, we are not trading using fair value gap. Okay, we are actually trading, waiting for the price to come and mitigate our order block, not fair value gap. When we go to the chart, we are going to look at that. So, price is not. We are not entering around there. We are making sure that price taps into our order block, not tapping into maybe our fair value gap. Our order block, not here but inside here. Same thing here is same thing we're having here, not here but here. So price tap into our demand zone, that's order block there, or our supply zone, our order block. So there must be that mitigation. That's what we call mitigation. So price mitigates our demand or our supply zone. Then what we are going to look at for lastly is going to be our entry criteria. Now this is how it looks like. Okay, now remember your demand zone or your supply zone. You must find that from you can analyze the market from the weekly time frame to see have an overview of what the market is doing. Okay, then you go down to your daily time frame, your hour time frame, or your 4 hours or 1 hour time frame. Now for our entry, we are looking at for our entry around, it could be the 15-minute time frame, the 10-minute time frame, the 5 or the 3-minute time frame, as the case may be. Alright, so now this is what we are looking at for. So after price tap into our demand zone or our supply zone. Okay, if it's our demand zone, we wait for price. We saw a break of structure, price tap into our demand zone. That's mitigation. The next thing is our entry criteria. What's our entry criteria? After price tapping, we are looking out for a break of structure as well on this lower time frame. We're looking out for a break of structure on this lower time frame. Break of structure. Oh, let me use this. I'm looking out for a break of structure. After the break of structure, price coming back to the zone that caused the break of structure, and then it moves up. So this is what we are looking at for. This is our entry criteria. So this is what we are going to be looking at for. Now this is a rule-based system. Okay, it means these are the things I'm going to be looking at for price doing. If I'm not seeing this in the market, I'm not going to take any trade. Okay, so you must stick to your strategy. You must stick to your plan. You must stick to your. Alright, let's go to the rechart. So let's start with this. Okay, let's start with this one first. Now let's start with this. This is a volatility 25 1x indices. So this is the chart before us. We are seeing the trend of the market first. Number one, we're looking at what's the trend of the market. We'll see it's in a bullish trend. The market is in a bullish move, going down to a daily time frame. These are daily time frames. So the market has been making a series of higher high, higher low, higher high, higher low, higher high, higher low, and then higher high. So it's in a bullish move. So let's go to 4 hour time frames so I can show us what we saw. Some places we would have gotten a clear entry. Alright, now this is the first place. We saw here that there was a break of structure. Here there was a break of structure. So we first of all saw our demand zone. It is our demand zone. Okay. Now, what makes it a valid demand zone? And of course, in that demand zone, there's going to be an order block. Okay. Whether it's a demand zone or a supply zone, there will be an order block. So this is our demand zone. We see there's an order block now, and then we saw a break of structure to the upside. There was a break of structure. So we saw break of structure. So break of structure. Okay. We saw the break of structure. After the break of structure, we also saw a fair value gap. What is a fair value gap? Now, between this candle and this candle, so we have this candle, this candle, this candle. Between these 3 candles, 1, 2, and 3, there is this void there. Okay, there is this void we are seeing here. There is this void we are seeing here. This is what we call fair value gap, or imbalance, or inefficiency. It means that price did not trade efficiently in this zone. Okay, price did not trade efficiently in this zone like these other ones. Like this other zone. You see, price was coming, there's no gap here. It was trading efficiently in these other zones. But when it got to this point, it created this candle, another one form, and then this form. So there's this void here. So we saw our order block. This is our demand zone in this case. And then we saw a momentum, a move to the upside, and this is the break of structure. This is the zone that caused this break of structure. And then we saw our fair value gap. After our fair value gap, what's the next thing? So after fair value gap, the next thing we are looking at for is, of course, we have known the market trend, the supply, our demand zone in this case. We have seen a fair value gap. The next thing, we have seen a break of structure. The next thing is mitigation. Number 5, mitigation, the OB mitigation. Okay, so which is what we saw here. So price came in and then mitigates our zone. It mitigates our zone. All right. Okay. We can also look at for something else, which I did not list here. Refinements. The refinement should come before the mitigation. There should be refinements around there. Okay, so let me just call this number 5. So number 5, mitigation. Okay, refinement. OB refinement. So let me call that number 5. This one will turn to number 6. And this will turn to number 7. Okay, so we have that OB refinement before the mitigation. So now what are we seeing here? So we are seeing this on 4 hours time frame. So we saw this zone that caused the break of structure, which is a demand zone, or we have an order block there. Okay, this candle that formed before this momentum that broke structure. So now this is the 4 hours. We are going to refine this zone further. You know, the lower the time frame, the less risky your trade is going to be. So you will have a higher risk to reward when you refine your entry. So now this is 4 hours order block or demand zone. So what I'm going to do, we are going to see if we can refine it further in the 2 hours time frame. Okay, to reduce use our to increase our risk reward. So come down to our 2 hours time frame. So coming down to our 2 hours time frame, so we see we can refine this zone further. We see we can refine it down to 2 hours. You see that, meaning we are reducing our risks and increasing our profit. So let's go to our 1 hour. Is there anything we can refine further? So coming down to our 1 hour time frame, you see we can also refine it down. Now do not over refine. Don't go and be refining to 30 minutes time frame and thereabouts, and there are 15 minute time frame. Be refining and refining. Don't over refine. Okay. I mostly look at for the daily. I do my analysis in the weekly time frame, and then I check the daily time frame. Okay, and then go to a 4 hours time frame, 2 hours time frame, at least 1 hour time frame. That's for the higher time frame. Okay, so we have refined this zone down to 1 hour time frame. So now, after the refinement, we saw the mitigation. So price can mitigate our zone. It mitigates our zone on the 1 hour time frame. So now, what do we look at for? Lastly, is our entry criteria, and this is our entry criteria. So the same thing the price did in the higher time frame, we're looking at for that same thing in the lower time frame. All right, so this is the mitigation. So what do? We are going to zoom down to our, let's start from the 15-minute time frame. So coming down to the 15-minute time frame, what are we seeing here? So this is 15-minute time frame. So price came and it mitigates. Now there was no entry here, so rather what did we see price do? Price came in, it took out this previous low, call this liquidity. So liquidity is like the fuel that moves price. So for price to go up, it will go down first, gather more momentum, take out people's stop losses before it goes up. So that's exactly what we saw here. So this is a liquidity sweep. Call this liquidity sweep. Liquidity sweep. So price took out this previous low, it forms another low. Okay, but there was nothing, no clear entry model here. So go down to our 10-minute time frame. So coming down to our 10-minute time frame. Coming down to our 10-minute time frame. So what did we see here? We saw that after this liquidity sweep, waiting for a break of structure. There was no break of structure until this place. So this is where we saw a break of structure. Break of structure. Okay, this is the break of structure. Meaning when price goes here, it's broke structure. It took out this high, this previous high. It also took out this previous high. It formed a new high. So this is the zone that caused that break of structure. This zone right here. This zone caused a break of structure. That means if we are going to take our entry, this is our 10 minutes time frame. We are going to take our entry at this zone. Okay. So if we're waiting for this market and we saw price did this, it took out liquidity. There are times you won't see liquidity sweep. Okay. It's not all the time you see liquidity sweep. Okay, so the times you just see the price, you just see price doing something like this. You just see price doing something like this. You just see something like this, and then you see a break of structure, and then okay. But in this case, there was a liquidity sweep, meaning you have something like this. And then the previous low was taken. We have this, and then we have the break of structure here. Okay, so it's not all the time we will have liquidity sweep, but liquidity sweep actually it's more confirmation, which we have seen here. So this is where we saw a break of structure, and the next thing we do, we put our buy limit. This is where we would have gotten. It could be instant execution. It could also be buy limit, depending on the situation. So I'll put my buy here and put my stop loss below this zone. Somewhere I can just, this should have been my buy, and then where would have been my exit? So coming down to let's go to a 1 hour. Let's see where I would have exited the trade. So let's go to 1 hour. So this is 1 hour time frame. This is 1 hour. So this is our zone. So this is where we would have exited the trade. Our next zone, this supply zone. This is a supply zone because it's because this zone broke structure to the downside. Okay. So this is a supply zone. So this is where we would have exited our trade. This is where we would have exited that trade. We would have exited our trade. Yeah. So we would have waited for price to come in, and then this supply zone is where we would have gotten out of the trade here. Yep. I've gotten out of the trade here. So this is how we would have gotten an entry using this model. Alright, so let's go to under one for the bearish example. So now we have this here. This is volatility 50. Volatility 50. So first of all, the trend of the market. The market has been in a downtrend. So this is a bearish market. Meaning it's making a series of lower high, lower low, lower high, lower low, lower high, lower low, lower high, lower low. So the price is going down. Okay, so we saw something here at this zone. This is our, this is 4 hour time frame. Let's go to our daily time frame. So we are still seeing a daily time frame. The market has been in a bearish move. Okay, so let's analyze from here. Let's analyze from here. So we saw that there was a break of structure there. So this candle was formed. So there was a break of structure like this. There was a break of structure. Yeah. Okay, it's going to be clearer when we go to a lower time frame. So coming down to a lower time frame, that's the 8 hours time frame. We saw this break of structure. After this break of structure, now this is the zone that caused the break of structure. This zone here. So this is the supply zone. So we have this other block here that caused this break of structure. That caused this break of structure. Okay. And then we'll now go to refining our zone. So go to a 4 hours time frame. There's nothing to refine here. It still remains that same zone. So going down to our 2 hours time frame. Okay. Going down to our 2 hours time frame. There's nothing to refine here. Still remain that same zone. So that same zone. Still that same zone. Okay. Now let's go to our 1 hour time frame. Coming down to a 1 hour time frame, we still have, now coming down to our time frame, we have 2 zones here. Okay, that's why I say you don't over refine. Okay, you have to be observant. Now, so we saw an OB in 8 hours time frame. We saw that same zone in 4 hour time frame. We saw the same zone in 2 hours time frame. Now coming down to our 1 hour time frame, we saw 2 zones. We saw one up here, and we saw another one here, another one here, another zone here. Okay, so the question you'll be asking yourself, which zone should I choose? Which one should I choose? Which zone should I choose? Which zone should I go for? Is it the one upper or the one on this one? So now the only way you can choose that is sticking to your rule. Remember we talked about the rule-based system. Okay, so we have an entry criteria, and this is our entry model. Okay, once price mitigates our zone, we look at for this double break of this break of structure before we take our trade. So coming back here, you have 2 zones. So wait for mitigation. So price came in, and then it mitigates our zone. You saw it reacted in this zone, not in this one. So why did we choose this zone? It's because of we have a rule-based system, which is our entry model. There are some things we are going to see before we take our trade. Alright. right? So price came in, tap into the zone, so wait for our entry model. Let's go to our 15-minute time frame. So coming down to our 15-minute time frame, what did we see here? There was nothing clearer here. Nothing very clear. It's actually clear, but it will be much more clearer if we go down to our 10-minute time frame. Okay, so coming down to our 10-minute time frame, so what did we see? So after the mitigation, so we waited for break of structure, just like we have here in this model. After the mitigation, wait for a break of structure. After the break of structure, we retest and then we buy for this case. But here we're having a bearish situation. So price tap into our zone. We saw a break of structure. This was a low that was created. This low was created, and then it broke the structure to the upside. So getting down to this place, it broke structure. So it took out this low. So price took out this previous low. So after price mitigate, it took out this previous low. Okay, it took out this previous low. Okay, now this is the zone that caused that break of structure. This zone, this zone, this other block, this zone, this particular other block, this zone. So now, how do we take our sell? We come in. It could be instant execution or sell limits. So put our sell here. Put our sell here. Stop loss above the zone. And then off we went. So where would have been our exit? Let's go to a 1 hour time frame. So this would have been our target. This would have been our targets. Previous swing low, or maybe we'll have a supply zone. So but previous swing low will be much better. So this is where we would have gotten our exits. This is how we would have entered, taken this trade. Okay, so when we have a situation like this, we will have two zones. Having refined it down to 1 hour. Remember, in the 4 hours, we did not have that issue. We just saw a mitigation. Let's go to the 4 hours. So in 4 hours, we just saw a mitigation. Price mitigate our zone. This bigger one. Okay, it mitigates this zone. Going down to our 2 hours, the zone remained the same, because this is where we have a fair value gap here. And then this is the zone. There's no fair value gap here. So this is the zone. Okay, this is the zone. And then coming down to our 1 hour time frame, we are seeing two zones, two supply zones. So which one do we choose? Wherever price gives us an entry model, which is exactly what we saw here in our 10 minutes time frame. So price came and did this and gave us this nice entry, so we took the trade, and this was our exit point. Okay, and that's cool. Now we if we go down to our 1 hour time frame, we still would have gotten another entry. Okay, when price came in, sold to those points, and then it went back up. Remember, we are in a bearish move. Okay, so we're looking out for a sell. The price came back up a little bit, and then it broke another structure to the downside. So there was a break of structure to the downside. After price went up, it broke structure. Okay, so this is the zone that caused the break of structure in the 1 hour time frame. So this zone caused the break of structure. So this is break of structure here caused by this zone. So we waited for mitigation. So after price did this, it went up, broke structure, tap into our zone, so it mitigated our zone. After this mitigation, the next thing we wait for entry model. So after this mitigation, wait for entry model. We'll go first of all to our 15 minutes time frame. So coming down to our 15-minute time frame. It's not very clear, so let's go to our 10-minute time frame. Remember, this is a mitigation. Price first of all mitigates here first. It mitigates. This is the first mitigation. this is the mitigation. All right, so price mitigated this zone, okay, our zone, and then that's our zone, our other block. So we waited for a break of structure. So we saw this break of structure to the downside. So there was a break of structure. Price came in, tap, it broke structure and did all this and did all this. Now this is the zone that caused the break of structure. This other block right here, it caused the break of structure. We saw this here. So price came in, mitigate that zone, and then it sold off. Remember our model, our entry model, this is how it looks like. A break of structure, tap rally back into our zone, and then we sell off. So this is what we are looking for in the bearish situation. So this is what we waited for, which is this, the break of structure. This is zone that caused the break of structure. We waited for price to tap in, and then we sell. Okay, so I can take this out. So now this would have been our sell. Would have placed our sell here, limits here. The price came in, and then our stop loss would have been above this. Okay, give it more space. The price came in, tap into that zone, and it sold. So where would have been our exit, coming down to our 1 hour time frame. So price came in. It would have been our exit point, the previous swing low. So this would have been our exit point. So price did all that, came in, and then we got out of the trade here. So with what we have now, we can still look at for a sell here in this zone. This is still another supply zone. You can still look at for a sell here, but I wouldn't do that. I wouldn't do that. I would not want to do that. Okay, let's go to our daily time frame base. That's where we know what to do. So coming down to our daily time frame, okay, we can still sell there. We can still look at for a sell, but I will not do that. Okay, the price is coming back. It might, respect this zone. It might respect this zone and sell off. It might do this and sell off, but it can also, this zone can also act as liquidity. Meaning, see this trend line you are seeing here that has been trending. You might have, if price wants to change direction, you might have something like this. Price coming in, take out all these highs, have a retrace, and then it goes up. So this might happen here. So I'm not looking at for any sell here, but you can, it might work. Okay, remember, market is not 100%. It's not 100%. But you see, if you stick to your rule-based system, if you stick to your rules, you discover that you will still be profitable. The only way you can be profitable is if you are consistent and sticking to your rules. But if you don't stick to your rules, if you're not consistent, you can never be profitable as a trader. That's just the simple truth. So alright guys, so just go ahead and practice, get acquainted with the charts, and then be consistent. Stick to your rule, and then you can try this with, say, at least 20 trades, and be consistent and see how it works, how it plays out. Record all your trade, and if you keep doing this, trust me, you are going to be profitable. So we'll see you in our next video. Bye.